Thanks for joining us for another conversation about hidden risks inside small businesses. Today, we're going to talk about reconciliation drift, the small bookkeeping choices that compound into surprise audits, margin losses, and operational headaches. We'll unpack why it happens and give you a prioritized playbook you can use this week.
Picture this. A mid-sized services firm waits 4 weeks to reconcile merchant statements. A handful of refunds are still floating, a payment was applied to the wrong client, and a vendor disputes an invoice because the credit memo never landed. A tax review follows, and suddenly the company faces a revenue reversal and an expensive audit. That's reconciliation drift in one short, painful scenario.
And the worst part is, every step felt reasonable at the moment. Someone delayed closing because they were overloaded. A sales rep issued a credit to keep a client happy, and the bookkeeper prioritized payroll. None of those are dramatic decisions, but together they create a brittle picture that attracts regulatory and contractual scrutiny.
Here's what we'll cover. What reconciliation drift includes: sales, refunds, merchant fees, deferred revenue, credits. What operational routes drive it, the legal and tax exposures, the cyber and data integrity risks, and then a realistic 7-day, 30-day, 90-day playbook. By the end, you should have a single source plan to reduce surprise liabilities and recover margin without ripping everything apart.
Let's start with the operational routes. Why do small teams drift into these patterns? From my experience, it's 3 things: handoffs, incentives, and timing. Sales hands the account to ops without a clear payment profile. Onboarding skips required documents, and the person who sells the deal doesn't own the ledger impact. That combination creates recurring mismatches. For service businesses, we see credits issued verbally to keep a client happy but never documented properly. For product businesses, returns are logged in one system, refunds in another, and fees in a third. No reconciliation owner. Over weeks, those small mismatches become a gap you can't explain to an auditor.
Legally, those gaps are where exposure hides. Misapplied payments and undocumented credits can create contractual breaches if the terms required specific notice or approval. For tax, if revenue recognition is off because deferred revenue wasn't updated, you can under or over-report income. In a dispute, insurers and counsel will want a clean trail. Without it, defenses weaken quickly. A practical question to ask your counsel is, what documentary evidence do we need to support refunds, credits, and revenue adjustments? Put that in a checklist. Second, consider how your contracts handle refunds and chargebacks. Clear language reduces ambiguity in a scramble.
From a cyber and systems perspective, reconciliation drift often starts with flaky integrations and poor logging. A payment processor drops a webhook, an ERP sync fails overnight, and nobody notices because there's no monitoring on reconciliation rates. That gap isn't just accounting noise. It's a forensic gap attackers can exploit to hide fraudulent refunds or tamper with payment allocations.
Simple controls make a big difference. Require immutable source references on any adjustment. Keep append-only logs for payment events, and set up alerts for anomalies, like a spike in issued credits or refunds above a threshold. Those alerts are low cost and catch problems early.
Okay, let's move to the prioritized playbook we promised. Start with 7 days. 3 checks you can put in place immediately. First, weekly merchant/processor match. Reconcile merchant statements against received deposits and ticketed transactions. Second, customer payment application check. Random sample 10 recent payments and verify the applied customer and invoice. Third, deferred revenue quick scan. Identify any large or old deferred balances over 90 days and flag for review. Who owns these? Assign the merchant match to whoever reconciles bank activity, the payment application check to a senior bookkeeper, and the deferred revenue scan to finance leadership. Clear ownership prevents the everyone thinks someone else did it problem.
For the 30-day window, engage counsel to review standard credit and refund language in your customer agreements. Document a formal adjustment policy, when a credit memo is allowed, who signs off, and how it's recorded. That reduces later disputes and helps if you're audited. Documented policies signal intent to control processes.
And technically for 30 days, Add simple monitoring and alerts. Integrate reconciliation exceptions into a single dashboard, even if it's a spreadsheet feed with alerting rules. Enforce source reference fields on all adjustments and make API retries visible. Those changes let you catch integration failures before the numbers drift.
For 90 days, aim to close the loop. Automate repetitive matching where reliable, formalize sign-off workflows for credits, and run a full transaction trail audit for the last 12 months, focusing on large or unusual refunds, chargebacks, and credits. That's when you remove recurring pain points and restore a single source of truth.
Also, document remediation steps and retain communications. If you find misapplied payments or old credits, produce a written remediation plan showing who did what and why. Important for insurers and tax examiners. It shows you acted responsibly once issues were discovered.
A compact case. A small e-commerce firm found a recurring $5,000 monthly discrepancy. Merchant fees weren't being reconciled to SKU-level sales because a custom integration truncated fee descriptions. They implemented a weekly merchant match, required fee descriptions to include SKU references, and added an alert for fee mismatches. Within 2 months, they recovered $10,000 in margin that had been quietly bleeding out, and an impending audit found clean records instead of a mess.
That example hits the point. Reconciliation drift often looks like a tiny leak until it becomes a waterfall. Let's wrap with the top 5 takeaways and a minimal weekly checklist you can use right away.
Top 5 takeaways. 1. Assign ownership for reconciliation tasks. 2. Reconcile merchant statements weekly. 3. Require documented authorizations for credits and refunds. 4. Add simple monitoring and immutable references for adjustments. 5. Involve counsel early for contract and tax language. These 5 reduce surprises and protect margin.
Minimal weekly checklist. Run the merchant match, sample verify 10 customer payments, review any credits issued that week, and log any deferred revenue movements. Keep the logs centralized and date-stamped.
Add a tech line. Verify integrations are healthy. Check exception dashboards and ensure all adjustments have source references. If you get an anomaly alert, escalate immediately. Don't let anomalies sit for weeks.
If you want the briefing we mentioned, a concise one-page checklist, sample adjustment policy language, and a starter monitoring rule set, go to hiddenbusinessrisk.com to get the Hidden Business Risk briefing. That's hiddenbusinessrisk.com. It's the only place we're sending these resources. Okay, that's it for today. Thanks to Jessica and Eddie for practical, grounded advice. And thanks to you for listening. If you take away one thing, let it be this. Small bookkeeping habits matter. Fix the small things early, and your business will avoid big surprises later.
Good luck with your reconciliations. Start with a weekly checklist and document everything. It pays off.
And set those alerts. Your future self will thank you.